They're an interesting asset manager, wealth management firm. Matt's going to share more about their focus, but what I wanted to draw your attention to is prior to Strive, Matt was a portfolio manager at CalPERS, where he oversaw more than $70 billion in actively managed fixed income portfolios. So please, let's give a round of applause for Matt Cole.
Hi everyone, hope you're having a good day here today. It's definitely a wild day in markets to disconnect and try to take a little bit of a step back at the bigger picture, but we'll try to do that and also weave in a little bit of current events that have obviously been unfolding over the last couple days. So the company I run, Strive, it was actually founded just a couple years ago in 2022 by Vivek Ramaswamy. And the reason that Strive came into existence was because of fiduciary duty issues that we saw in this industry. And if you think about the job of an asset manager or a wealth manager, we all have a fiduciary duty. And that fiduciary duty is to maximize value, that we must put the client first. You must put the client first ahead of your own interest and ahead of your company's interest. That's our job. If you have a CFA or if you're in this industry, that is what you pledge to do. But what we were seeing was the rise of social and political values, and this is not even talking about whether someone agrees with the values or disagrees with the values, but social and political values around the rise of ESG and the rise of DEI that were gonna harm value to investors. And so many people around the United States, around the globe, saw this from their various perspectives. As I was introduced prior to Strive, I was at CalPERS. I oversaw a lot of money. And when I was there for 16 years actually. And over the course of my tenure there, towards the end, there became pressure for me to buy bonds that were trading at a higher price or a tighter spread to treasuries. We're talking about corporate bonds, structured bonds, because they were green. And I have nothing against green energy. I love the outdoors. I'm sure many people here love the outdoors, but that would be a violation of my fiduciary duty. If I buy a bond that has a higher price just because it has a green logo next to it because the proceeds were used to put solar panels on Apple's building or something like that, that's a violation of my fiduciary duty. So I stood against that. Many other people stood against this from various perspectives, and Vivek had the foresight to start Strive, to actually create an asset manager, say, hey, if other large asset managers are gonna move in this direction, if they're going to sign pledges and they're gonna call American shareholder capitalism or shareholder primacy, the idea that the shareholder is the most important stakeholder, if that's gonna be called outdated by every large asset manager in the country, well then one, we have a problem. Capitalism is at risk. And two, from a business perspective, there's a large opportunity. So that's what Strive started at. And so, we've been branded the anti-woke firm, the anti-ESG firm, and we always said no because it's important as investors to be principled, and to stand against something is not the way you build a business. It's actually what you stand for. And so we stood unapologetically for capitalism, for shareholder primacy, that our jobs is to put the shareholder above all of other stakeholders, because when people put their money at risk, that's what they're signing up for. To say that meritocracy, the idea that you hire the best person for a job, regardless of that individual's race, regardless of that individual's gender, is the right way to think about hiring decisions. And frankly, in a diverse country like America, you hire the best person, you're likely to end up with a very diverse crowd, but not because you're searching for diversity, but you're searching for excellence. And so to be very principled in what we stand for, that's what we started. And then initially people said, this is great, like I understand what you're saying, I agree with it, but what's the investment case? Can you actually talk about the investment case? And so actually our head of research is here, a gentleman, Chris Nicholson, and one of our portfolio managers, Jeff Sherman, is in the crowd right now. And the three of us actually worked a lot to say, what are the different ways that we can frame this? And one of the best ways to frame the value of American capitalism from every different angle, from regulations to incentives, was to look at how American equities actually have outperformed European equities over the last 40 years. Because if you actually look at Europe as a bunch of nations, most European countries actually adopted stakeholder capitalism as their economic model in the 1980s. At the rise of Klaus Schwab, who was leading the World Economic Forum, he coined this term that you shouldn't prioritize the shareholder over other stakeholders. You should actually cause all stakeholders are equal, whether you're the customer, the employee, the shareholder, and that's what they did in most European countries. And so what were the results? 40 years is a long time. And the results are pretty staggering, actually, about a 3.5% difference per year. And what that means is you compound 3.5% difference over 40 years, and you actually get over a 2,000% return difference over 40 years. And so this is really interesting on a bunch of different metrics. One, if you think about the average career, someone may graduate college, they're in their mid-20s, maybe they work till their mid-60s. That's 40 years. 40 years is basically someone's career. Well, if you actually then put in the returns of the European stock market and compound those over 40 years, and you do the same for American equities, what you see is basically the difference between being able to have a secure retirement and not being able to have a secure retirement. And so that's what we're talking about. And there was a lot of other research that we actually dug into regarding meritocracy versus quotas and DEI. We actually dug into the studies that actually had those concepts behind DEI pushed into corporate America, namely a series of 3 studies by the McKinsey Group. And what those 3 studies actually showed were a bunch of statistical issues. And obviously this crowd is a bunch of finance people, probably a lot of people similar to myself that are math nerds. And as, at least for myself, a math nerd and working with some fellow math nerds, there's a lot of statistical issues with these 3 studies that formed the foundation of DEI in America. And so one of them was that these studies that showed the performance difference, they actually didn't have a p-value of less than 0.05. So for those that want a reminder of data science 101, you actually, to prove statistical significance, have to have a p-value of less than 0.05. Otherwise, your findings aren't statistically significant. All of these studies failed to meet that metric. Secondarily, there was 3 studies, and you would think that if I'm doing 3 studies over time and I'm thinking about science and how do I prove a point with the highest level of statistical integrity, that over those 3 studies I would keep consistent the countries that are in the studies, but yet from one study to the next, some countries would randomly be pulled out, some would be put back in. And then lastly, you would say, okay, if there's 3 studies for 3 different time periods, those time periods should be 3 distinct time periods, maybe the 80s, the 90s, and the 2000s. But no, all 3 studies had random overlapping time periods. So you put all those things together, lack of statistical significance, overlapping time periods, and random removals of countries, and what you come out with is that these studies were statistically garbage. And so the truth is of the matter with regards to DEI is not that hiring less diversity means you're going to outperform. It means the actual truth of what the data says is that there's no correlation between diversity on the basis of skin color and gender and performance. And so what that should mean is that should be encouraging, that in America we should lean into hiring the best person for a job. And so that was a stance that we took, and we have engaged with a lot of companies. So our firm has 13 ETFs. We actually are, our clients are owners through our ETFs, call it the top 2,000 companies in America, and then many international companies in developed and emerging markets. But when we started, and to this day, we engage. Even though our funds are index funds, we believe that we need to push these companies to adopt all these core principles that we talk about. capitalism, innovation, meritocracy. And so we started engaging with these companies, and at first it was talking to them about some of the flaws, about some of the studies that were the basis of, with regards to at least DEI, their programs that they had implemented. And then it even evolved with some of the Supreme Court rulings. And so this gets into activism in defense of capitalism and kind of some learnings that I think are interesting learnings, because everybody in here, I'm sure, is an owner of many companies. And in case, I'm guessing many people don't vote their shares. And so one thing is a reminder and a recommendation for everyone to actually take these proxies seriously, because for the people in the crowd that are retail investors, most retail investors don't vote their shares. And so what that means is it means that all institutions, the value of their vote and their voice goes up dramatically because retail is not voting their shares. So your vote does matter. Think about it as like a civic duty as a citizen. If you're an investor, vote your shares, let your voice be heard. But second, also the power of engagement. And so this was something that was frankly shocking to me, that when Strive started, we obviously had basically no assets. Right now we have $2 billion of AUM on our asset management side of the business, which is one of the fastest growing asset managers in the last couple decades, but also it's tiny. Like, we have $2 billion, BlackRock has $10 trillion, Vanguard, State Street also all have similar types of AUM. But what I learned was twofold. One, when you actually give a coherent argument to the boards of companies as a shareholder, whether it's Strive or any of you in this room, that if it's principled, many companies will listen to you. So that was one of our early learnings, and we had a couple big wins very early on. One at Exxon, where they had actually had 3 climate activists pushed onto their board, even though Exxon had recommended against it. This was in 2021, and they didn't have the requirements to sit on the board of a major oil and gas company. We actually engaged with Exxon in late 2022, calling this out and talking about the need to balance those voices with additional oil and gas experts. And within a month later, they actually took the proactive step of putting 2 additional qualified industry experts on their board. And so that was a big win early on in Strive, way faster than expected. But the other thing that happened for our company that I think was interesting is that companies actually reach out to us. And that was surprising. But when you actually unpeel the motivations here, it should be less surprising. You think about the values, the capitalism, pro-capitalism values that I talked about Strive having. Well, many C-suite members in corporate America, many board members in corporate America agree with Strive and have felt silenced for various different reasons. And so when that's the case, even a small asset manager like Strive can make a big difference in corporate America. And just to take a quick step back, in 2022, think about how contrarian everything that I just said was. When Strive was founded, standing up against ESG, against DEI, standing unapologetically for capitalism, meritocracy, that's grounds to get canceled in 2022. We were told we were backward looking, that we would never win. And think about our country today. What Strive stands for today has moved from the contrarian position to, I'd say, the consensus position of this country in a major way. And I say that from a position of humility, but I really felt strongly that was going to happen because of all the executives that were reaching out to us. And so at this point, Strive's focus is still to vote our shares and engage with companies with regards to these issues and push them in the right direction. But with regards to activism, and this gets into, if you've seen part of the conversation for today around Bitcoin, is that it was never just about standing against those things. It was standing for our values. And activism only matters if you're standing for something that's contrarian. If you're standing for something that's consensus, then yes, you vote the consensus, but full-out activism is mostly unnecessary with regards to a consensus opinion. And so we still do engage with the ESG and the DEI issues, but it's actually more on a basis of when we get called by companies and ask us to, well, we do it, and we still vote in that way. But our new activist focus is on Bitcoin corporate treasury adoption. And my guess is that in this room, there's some people that are pro-Bitcoin and some people that may be skeptical or are not educated in Bitcoin. But there's a couple different reasons why we think this is important. And one of them has nothing to do with Bitcoin. It actually has to do with AI disruption. And so if you look at the tech boom, and I only have a couple minutes, so I'm going to try to speed this up a bit, but in the tech boom of the 2000s, if you take 1990 to today, there was an 80% turnover in the S&P 500. 80% of the companies that were in there in 1990 are no longer in there. If you think about technological innovation, it always moves faster. So when we think about AI is likely to disrupt an order of magnitude faster. We don't know how much, but let's just say it's twice as fast. In the next 15 years, there might be another 80% disruption in the S&P 500 as AI disrupts. And even if companies lean into AI, they might reduce their costs, but there might be companies that come up to compete against them with 5 people through AI, and there's no way that the incumbents are going to be able to protect against that. And if they start getting disrupted, what you'll see is their market value come down very quickly, and at that point, they're in a death spiral. And so that part of the argument actually ties to what should a company do if their corporate moat's at serious risk. And what we think is they should actually increase the size of their balance sheet, prepare for an unknown and a risky future. That's not an argument for Bitcoin. It's just more cash on the balance sheet if you have the opportunity, which they do today. The second is, what is a true savings vehicle today? And if you think about where we're going, and this actually ties into the tariff conversations today, Bitcoin's actually up over the last 2 years. 2 days. It's probably up over the last 2 years too, but over the last 2 days, when equity markets have been completely hammered, fixed income's up a bit, but there really has been no hedge outside of something like Bitcoin. And if you even look from the election to today, Bitcoin's up 20%, stocks are down, bonds are down, the Mag 7 is down, gold is up, but Bitcoin's up more. Bitcoin is showing the ability to be a true savings vehicle, which we think is going to persist into the coming decades. And when you believe that, and you believe that in a world of abundance, which AI is likely to be a world of abundance, that you want something that's scarce, and that Bitcoin as a treasury reserve asset, as we prepare for the coming AI boom, makes a lot of sense for corporate treasuries. This is not an argument for every company to become MicroStrategy. No. It's actually to keep their corporate mission, but to prepare with a war chest of capital, to prepare for a future that's likely to disrupt their business in a major way, while still leaning into AI, but accepting that that might not be enough. And having that capital in the future will allow them to do things like acquire businesses that might be failing. And so we've engaged with a lot of different companies on that. We plan to hopefully help at least one company per sector adopt the Bitcoin standard over the next year. And then on the wealth side of our business, we actually recommend a core allocation to Bitcoin for all of our clients in the 3 to 5% range. And I think of that as both a return enhancer, but also a risk reducer. So if you think about the efficient frontier of maximizing risk-adjusted returns, you can do that better with historical data by implementing a allocation to Bitcoin in your portfolio. So I think my time is up, but I think we can take a couple questions if there are any. So open it up. Did you raise your hand, or is that or sorry. Yeah. Yeah, we are. So our view is that Bitcoin is a distinct asset from the other cryptocurrencies and a true, call it digital gold, that we have pure conviction in, that's going to have long run value. And the other cryptocurrencies, I think of them more as venture investing. And venture investing is not to say that all of them go to zero, but there's literally millions of cryptocurrencies right now. Now, obviously, if we talk about the majors and include Ethereum or Solana, you're talking about more of like the blue chips. And I do think that some of them are going to have value, but for very different reasons. And I don't think that they necessarily will act as a hedge or a savings asset for corporations or nation states, just like how the United States with their strategic Bitcoin reserve, they separated out the other cryptocurrencies, including Ethereum, because of the distinctive nature between them.
What's been your history record, since 22, I think,
Mm-hmm.
what's been your, I don't know if, oh, okay, it's on. I didn't know it was
Record of our funds?
Yeah, what's the record of the funds? What kind of commission do you charge?
Mm-hmm.
What's your main focus in the fund? Is it just anything, or is it specifically oriented toward just non-DEI type?
Yeah,
things?
so 13 different ETFs, and 11 of them are passively managed equity ETFs, so call it like a 500 fund, a value fund, a growth fund. And the idea is to charge a rate that's in range with the major asset managers. So whatever that range will be, we're typically not at the absolute low end of the range as a startup, but a fair price within range for that type of asset, and provide large cap, mid cap, small cap value growth. And so with most ETFs, and ours are no different, when they're passive, they track the index well. But we're up to the mercies of the index. So our 500 fund did not have a good day today because the index did not have a good day today. We have 2 actively managed fixed income funds. So my background's fixed income. One's a total return bond fund, and then the other's a more ultra short, call it less than 1 year duration, that tend to offer 3-year treasuries plus some additional, and those ones have done pretty well versus the index. We do have high yield in our total return bond fund, but not high yield only. It looks like we are up. So thank you, everybody. Much appreciated.